Now, before we get into it, as we talked about in segment one, we went through some of the Chinese refined product exports. They remain at seasonally adjusted all-time highs. That's something that, again, is pointing to some of the issues with storage as they approach, almost 1 billion barrels in oil storage. And we'll talk about that a bit more as we go through, as we see some of those slowdowns in new physical pricing and purchases. But first, let's look at U.S. exports, because this is where we continue to see the problem on U.S. crude oil exports into the global market. But when we just, touching on that first, when you look at the decline of 39,000 barrels a day, down to about 2.481 million a day, you can see that we're down almost 1.4 year over year. And that is where we continue to see some of that pressure as Europe has the renewed lockdown. Asia demand remains slow, which is really keeping our exports, essentially backed up. So as we've highlighted, there's about a stable bid of 1.8 to 1.6 million barrels a day. And then everything after that is like spot, as you need it. And that's where we're seeing some of that get whittled down, as you can see with just this pressure in general. We think, as we start to get into a bit more of a normal market, hopefully in the summer, we'll start to see this pick back up, but it's not going to be in a sizable way. We're expecting that 2.6 to 2.8, that kind of average going forward. And then when we look at shifting to the refined product side, you can see that gasoline took another leg down of 147,000 barrels a day. That's one that we think is going to continue to struggle as we keep talking about Latin America with just the resurgence of virus in Brazil, some additional lockdowns, economic problems in Argentina, additional flows from Europe into our markets, or our markets in general on the coast, but also into some of our export markets. And that's where we're going to continue to see some of these issues where, and we'll talk about this more with Fujairah, when we continue to see this backup where Europe is taking market share and pushing product further into West Africa. West Africa is buying less from the Middle East, which is pushing that further into Asia. China is then pushing from the other side, sending more product into the market with, based on, early indications, April's going to be up from March, and March was up from February. So again, we're seeing this friction in terms of where is this product going to end up. Now, on the distillate side, we were expecting another, essentially going flat to down. Instead, we went up by 441,000 barrels a day. That's one that we think is going to take a hard shift down and get closer to about that 700,000 that we were expecting. Again, there's more timing in terms of that, just because this is, we have another surge of diesel coming and distillate coming into the U.S. from Europe. And then Europe is actually at an 11-month low coming from Asia with, some new cargoes being signed up coming out of India. So this could be kind of this last push where they were trying to get some pricing, trying to manage some of their storage levels. But the renewed lockdown will, again, kind of cap some of that near-term demand. So that's something that will come under pressure. On the LPG side, we have an increase of 292,000 barrels a day, keeping us well above that 5-year, but down against that year over year. That's one that we think is going to continue to see a bit more of an upswing. But the question is going to be how much of that is poly versus propane and and propylene, just because there is that pricing benefit in general to stay local versus abroad. But again, there's still that natural bid in that open market. So when we look at gasoline, you can see against the 9-year, we're coming into the low side. We don't think we're going to continue to go down. It's now just based on where it is. It's going to kind of flatline, start to trend up a bit. Again, not up back to the 5-year, but or 9-year average rather, but closer to kind of a bit more normalcy as we suck around at the lower end scale. Just because based on just U.S. demand, why would I export it into other areas, which is going to increase my cost for shipping and other, when I can go into the U.S. markets? The issue then comes to, well, I might export it anyway because I don't have to blend it. But now there's talk about some blending credit leniency, but that's something that we'll look at and talk about more next week. Then when we look at distillate exports, we were expecting us to stay below that 9-year average at the bottom of the cloud. Instead, we went right up to the 9-year average. That's something that we think, again, is going to pull back a bit, and it'll just come closer to, again, that bottom of the cloud in general, just because we're not seeing that real demand in the European theater. Then when we look at crude oil exports, as we were saying, we're just going to kind of suck around this in between the 5-year average and that top that was achieved, whether it be 2019 or 2020, depending on where that peak is. But we're just going to sit around at these levels just because there's just going to be that inherent pressure on U.S. exports. And here you can see just that recovery. We actually normally see a spike this time. It's just when the spike comes down, we think it's just going to remain really at the top of that cloud as the LPG exports still remain elevated in general. Genscape, when we start looking at European onshore storage, you can see that there was a small decline, but typically, we're following the trend of increasing onshore storage. Some of the headwinds that we get, because right now China did buy some more West African at a bit of a discount. We'll talk about that. And some North Sea, but now that is coming down. So this is something where we think we're going to get a bit more onshore storage over the next couple of weeks as they go from to avoid floating onshore. But again, these are things that are going to be that push me, pull me side of the equation. On the Fujairah side, the Fujairah reported 17.683 million barrels. Total stock fell 1.534, which is actually back to a multi-year low, which is a net positive. And now we have to look at what are some of the pieces. So, the draws we're seeing in the light disty and the heavy residual side, while middle distillate actually saw an increase, but there's more to it than that. So stock of light distillate saw a draw of 739,000 barrels, reflecting a fall of 9.7% week on week to that 6.9 that you see. The east of Suez gasoline market continues to weaken though. And that's where, the expectation of a rise in U.S. gasoline stock and then exports from China in April continue to be that headwind because they're continuing to see an elevated increase of April numbers as the data comes through. So they're also making room for what they expect to come in because it's going to start hitting and show up in some of these specific markets throughout Asia, and then obviously kind of stop and reside in the Middle East. And we're already hearing that Fujairah is going to increase storage capacity because it would make sense given that the Middle East is also increasing refinery throughput. So you kind of have to have, if you're going to increase refinery throughput, well, you need a place to put the stuff. So you have to build more tanks to put the stuff. So again, that makes a bit more sense. Then when we shift over to the middle distillate side, when we look at, just to round out that component on the gasoline. So China had exported 1.6 million tons of gasoline in February, and that was really going into Singapore, Philippines, Indonesia, and Pakistan as their top destinations. But as we see Singapore remaining elevated, Indonesia struggling, Pac kind of struggling a bit, that's going to push more into Fujairah. Stocks in middle distillate rose 194,000 barrels. To that 3.655, up 5.6% on the week. The gas oil market again remains on bearish. It has that knock-on effect on the oil the price decline and just that slowing demand into Europe. And then on the residual side, residual fell about 12.2% by 989,000 barrels to that 7.115, and there was that knock-on effect from that huge drop in just oil pricing in general, just because the oil price is coming down, again, enabled them to sell more at better prices. So people try to be opportunistic, which again moved more product, which will start to pare back. It's just, based on what we're seeing, we expect middle and light to still see some steady increases, but resid is going to stay fairly down, just given where some of the pricing is in the market on the bunker side. Now shifting into the loading schedule. If you look at March, you can see that March has actually declined because we've already started to get some deferrals. So the deferrals have gone from March into April and actually slipped from April into May. So we're starting to see some of this movement because we're just not getting that demand for cargoes. So to try to minimize floating storage, you try to keep it either in onshore tanks or reduce production to a point to try to manage some of these, the supply chain in general. So Angola had that dip down as we saw going into from March into April, and now we're getting some April into May. Same with Nigeria. Congo is still sitting on several cargoes. As Russia continues to see, try to push a steady increase. The problem with what Russia is doing, there's a problem with China. And let's just look at this in general. So 20 to 25 cargoes of Nigerian crude in April are still unsold. 4 to 7 cargoes for April are still available. 3 to 4 were on consignment for loading, but now we're being re-offered. So again, that's something that normally doesn't happen to this level and size. So that, again, speaking to some of those issues, and then 2 cargoes for Congo are still available. Now, the bigger issue is 20 ESPO cargoes in March and April remain unsold, and there's nobody bidding right now. And that's something that Big Orion spoke about, and I think it's an important aspect because ESPO and North Sea pricing had been fairly steady as we looked into some of the other areas where we talked about physical prices being weak in West Africa and Urals and CPC. But North Sea and ESPO had maintained, even though the bid was starting to come down, it was still at a premium, and that has now really whittled down to nothing as Asia, and more specifically China, has really cooled on their buying as we go into April. Now, Gunvor just sold Urals at a higher price than previous trade. So what does that mean? The previous trade was at 240, a discount of 245. It's now less 210. So a little bit better in the market as we're starting to see some adjustments in general, but again, still sucking around that 11-month low in general. Now, when we look at some of the specifics in general, so the CPC grade recently bid at a discount of about 290 versus dated Brent, which would be the lowest in almost a year. Abu Dhabi's Murban crude for May 1st to 25th loading at a 20-cent premium to the grade's official selling price. That's a 5-cent discount versus previous. And then we had Russian Sokol crude for the second half of May loading at a 250 a barrel premium to Dubai, which is lower than the initial of 290. So again, seeing some of these premiums come off, and it's really being driven by the ESPO that we continue to see as kind of the bellwether of pulling some of this down, because ESPO is the shortest distance to China. It is a crude that they're looking for, and China continues to take some of this Iranian crude under different guises, and it's also limiting to some of the stuff that they're taking from not only just Russia, but other parts of the Middle East. So this is increasing crude on the oil on the water. We're seeing this tick up, and it's, again, maintaining above that 5-year average. Oil in transit had that sharp move up because we did get an increase in sales from West Africa at these pretty steep discounts. Nigeria is now currently selling 2 of their crown jewels, if you will, at 20-year lows on differentials, just to give you an idea of the pressure. And the U.S. competes against Libyan crude into Europe, and really West African crude into Asia. So if you're seeing these big discounts start to come out for April out of Nigeria and Angola, that's again going to keep the U.S. Essentially capped. But just based on the oil in transit, we normally see a little bit of an increase here, so we think that's going to continue to move in that direction. Crude oil and floating storage had a small decline, still remaining obviously well above the seasonal norms. And right now we have about 96.46 million sitting in storage, which is down a little bit from that 103 that we saw. The issue now is going to be the Suez Canal. The Suez Canal, does that delay some loadings? Does that keep stuff in specific locations? Again, that's going to just be something that's going to be that short-term timing delay that will be the residual impact. Then when we look at Asia, at Europe, you can see that even though Europe had a record amount or near record amount of exports of gasoline, you can see that they only drew down about 23,000 tons, and we're still sitting at that 1.383. And when we look at gas oil, that came down about 59. But then when we look at fuel oil and jet, we're starting to see some of those increases. So again, it's just going to be a matter of kind of managing it. And when we look at looking at gas oil, you can see that they're now down below that 14-year average. but it's starting to, again, kind of holding that level just because they're not really consuming that much internally, but there's a lot out there. So they're trying to manage pricing and manage those numbers, where when we look at gasoline, they're at a seasonally adjusted all-time high, slightly down off of that peak as we did get that big surge. But just looking at this, there is more than enough gasoline to send into the U.S., Caribbean, Latin American, West African market, just given the amount of in storage and the lack of near-term demand. And by near-term, I mean actually straight through not only just April, but actually hitting into May when you look at what is available in the market, which is, again, pushing back on Singapore. So here you can see Singapore still remaining elevated at 52.3 million in storage. You can see just from this 15-year average, we normally get this storage move increase, and then it normally peaks right around this time, and then either goes flat or starts to fall a little bit. Just based on what we're seeing out of China, the issues in Southeast Asia, the issues in China, this is something that we think we're going to maintain the top of the cloud. And depending on where kind of those spikes are, we'll see those seasonally adjusted all-time highs. And really, what is driving that? And that's when we start looking at middle distillate. So you can see it's come back into the top of the cloud. We normally see this kind of flat line here just based on what we're seeing out of China. We expect this to start to increase, especially with the fall in demand coming in India, which means that they're going to look to export more because they're not consuming as much internally, keeping this elevated. And now when we look at light distillate, we're still at this very elevated level. And that's why we're starting to see more South Korean cargoes get sent into the U.S. And we expect to see more light distillate cargoes all targeting PADD 5 because, PADD 5 gasoline is almost $3.50 depending on where you are. There's some reopening. This is where we're going to see an increase as some of this continues to flow from Asia and into PADD 5. Now, just looking at some time spreads, here you can see that we went negative, which just means that we went into contango. Now there's at a premium of 4 cents. You can just see how quickly that drop happened. And this is something where we never really understood why it was at these levels, just given what we were seeing in the physical market. And now we're starting to see that start to come back in. Obviously, we had an increase in crude pricing right now. We're currently up $3 at 60.84. Again, we've had these big drops. I think that once you start to get some of this narrative shift, all of a sudden the physical market mattered and it was making headlines, but the physical market had been a problem for a while. And when we talk about narrative, just to be clear, if the paper market was at $50 and Urals or pick your cargo were trading at a premium of $1, even though they should be trading at a premium of 10 cents or a discount of 10 cents, and they're trading 90 cents above where they should be, you couldn't find a bigger bull than me. It's just I'm looking at what is the physical market telling me, and then what does that mean for economic activity? What does that mean for flows? Because this is a big, thick, fat market, and the U.S. is a big part of it, but it's not all of it. Is the U.S. 20% of demand? Absolutely. That is an absolute fact. China is a growing piece of that. It's just there's other pieces to it. And if other individuals or other countries aren't consuming, well, there's just more product to go fill some of this void. And that's why even if you get some additional recovery out of the U.S., it doesn't mean that we're going to see tightness in the overall market, because we're just going to see, shifting tides, and the product will move to the best market. And that's where we continue to see. It's not tightening the underlying market, it's just moving trade flows. And those are some of those key things that we like to just rehash in general. Now, when we look at Singapore, speaking to what is happening with China, and again giving some of that more credence to it, you can see this rollover in just cracks and margins as we get this backstop of more product getting pushed into the Asian market. And that's sending the Dubai hydrocracking into seasonally adjusted all-time lows and lows for the year. So not only is it a seasonally adjusted low, it's at the worst price this year in 2021. Again, it's not indicative of a very strong recovery, especially in Asia. Now on the Ural side, this is where we're starting to see a little bit more of a benefit with some Ural activity. You know, we're back over positive for pretty much everything. We've bounced off the lows. So this is going to keep some of those Urals moving into the market, especially at the discount that they're currently going at. And Russia needs this. Why? They raised rates. They had to pull their bond offering after the Turkey debacle. And India continues to see an increase in inflation. So again, we're seeing some of these pressures coming in, which is why those discounts are going to be available. Because if you provide a discount at the crude level, that helps refinery margins. So that's when we're looking at you, Saudi Arabia, because if you want to increase some of the benefits, you don't have to increase production. You can just cut OSPs because they're already trading below screens for some of these cargoes to move some of the product. Now, looking at this in the Mediterranean, you can see that there's this bifurcation in terms of where the data is. And this is why Europe, again, if you think about Urals making middle distillate has been kind of the better spot versus the gasoline side. So it makes sense to see some of the benefits at the middle disti side versus gasoline, which is not something that we see changing anytime soon. Now, when we look at Chinese crude imports, you can see that they're still remaining at all-time highs on that seasonally adjusted level, obviously back down from and we're just seeing that continuously as they're purchasing less and less and trying to be more picky on price and some of the other key components when we're looking at the underlying aggregates. And we're starting to see the slowdowns that we've been talking about on refinery throughput. Now, to be clear, people, companies, when they're buying in April and May, that's going to run in the summer. So if you buy in April, it takes, anywhere based on where you're buying it from 3 to 8 weeks to come to your shore. Then once it's at your shore, then it's, let's say 6 to 12 days from the boat to the tank. And then it's another 6 to 8 weeks in the tank before your refiner. So you're buying now for summer. So if you're not buying aggressively now, do you see an issue in terms of where your summer demand is going to be? Are you trying to play this game on pricing? And that's where there's that kind of headwind of, well, what does summer demand really look like, especially in Asia and Latin America and Europe, based on where some of these prices are? And, this is just coming through. We talked about the slowdown in refinery throughput in China. It's starting to come down. Shandong, we saw, they had about a 1% decline to 72.54. And then when we look at state-owned refiners, they've all come down anywhere from 3 to 5%. Some of them were already running at very declined levels, and they're just going to stay there. But some of the ones that were operating at, let's 84% are now at 74%, 76%. So you're seeing that 5% or so decline as we get this extended turnaround season, which is going to put more stuff into storage, which is going to put more stuff into the export markets. But there's quotas. So when you look at China, China has quotas on imports and exports. So you can't just say, well, I have a ton in the tank, I'm just going to dump it into the market. No, you have to manage it. And that's where we're getting this managing side. And this is what is going to be key when we look at what does summer demand look like? What does summer crude demand look like, given that you're buying now for summer? And right now the numbers aren't all that great. Here you can see that we're starting to get an increase in Asian floating storage. We think that's going to continue to remain elevated and actually trend back to the highs based on China, based on India problems, Southeast Asia in general. South Korea is getting some normalcy, still well off normal levels. But again, it's just going to put more crude in the storage market. North Sea is trending higher. Just based on what's been sold, what's been moved, we should see a little bit of a decline, but again, still maintaining the well above that 5-year average in general. Now, West Africa, we were expecting this shift up, but because they were able to sell some cargoes at some pretty steep discounts and actually defer cargoes out a month or two, that took some of that additional crude that we were expecting to come through, that left it in the tanks, left it in the ground, depending on where it is in timing. So that's why we're back to the bottom of this. Based on their really getting aggressive on pricing, we think it's now going to stay below that 5-year average, but it's still going to remain elevated in general, or at least in the cloud, as we continue to see some of the issues on the Asian side. Now, it's an interesting fact here because when you break it out, we're obviously below 2017 or right with 2017, obviously well below 2016. Again, when you think about, using the 5-year average and just the amount of crude that was in the world in 2016 from just the OPEC fallout. But when you look at just where we are, the Middle East is elevated, and it's something that we think is going to remain elevated. The UAE is already kind of saber rattling on what they're going to do with their crude. We have the neutral zone that's increasing. It's right now at about 105 to 150,000, on its way to 300. That is excluded from the deal. Libya is talking about getting to 1.45. They're excluded from the OPEC Plus deal. So these are going to be things to manage, because even though Saudi has kept their production cut, they've kept exports flat. And that's where is that because of the neutral zone? Is that because of some of this, they're just moving it from their tank to someone else's? Again, these are some of the conflicting data points. When we look at Europe, again, as this is something that still remains elevated as it goes from European floating storage to onshore storage. That's where we're going to get this movement. And again, we're going to continue to see that remain above the 5-year average. Now, when we look at, as we talked to the URSA, satellite data, here's where you can see that there's been shifts where there's in 2016, we actually had higher than. But when you look at just where we sit today, and this data is a bit more leading than the URSA data, which, let me just see. So this is as of the 19th, theirs is as of the 18th. So there's been a small pullback, but, as you can see, we're still at seasonally adjusted all-time highs in teapots, with refinery throughput coming down, more boats showing up. So again, you're going to see this push higher, and we're going to see more in storage. And that's really leading to, and as we see here, those increases in fuel oil stocks. It's still down. We're still seeing some of that throughput, that decline. And this is really coming in the way of reduction in not only throughput, but also an increase in exports to try to balance that market. So know that there's a lot that we went through. The market has been very volatile, as anybody can tell. So these are things that we're always looking at and trying to go through the noise, through the narrative, and trying to find what is the actual data saying, what is it projecting going forward, because the physical market is projecting out. It is a forward-looking view, especially on economic activity. And if economic activity falters, well, that's wages, that's jobs, that's just general GDP. And what does GDP run on? It runs on gasoline, it runs on diesel, it runs on fuel oil, it runs on just the back of energy. Now, as much as people want to replace it, it's still a huge input. So that's why we look at the tanks so much, the boats, where are things going, because it's also indicative of that GDP side, which is why the macroeconomic show, the energy show, they're very much correlated, at least in my mind, in terms of what drives what and what are their interlinking drivers, because I think energy is really the driver of a lot of things, and everything else is kind of reactive. So it's just a matter of how is that reacting and what are the correlations at that time period. So thanks again for watching. We always appreciate your comments, liking, sharing, subscribing. It helps us, it supports us. So thanks again for watching. Thanks again for your support. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.